Welcome to the FitBucks podcast. I'm Joseph Ranke. If you're watching on YouTube, welcome as well. If you are watching on YouTube, be sure to subscribe to the channel so that way you can see and watch your future episodes. Same with the podcast. Make sure that you subscribe so you can then download future podcasts. Today we have a special one for students and those that are going back into school. Maybe you start your program in a few months from now. Just to let you know, the date of this recording is early May of 2020. So this is some of the stuff we're going to be talking about is very specific to the interest rates right now. However, you can learn these tricks and keep an eye out for this every May. What am I going to be talking about today? Is strategies in terms of which loans to take out, especially if you're in grad school. You're going to want to listen to this because you probably have really high interest rates from the last few semesters. If you've already been in school, probably around 6-7%. I got some good news. As of today, if the rates stayed where they're at, the interest rates on your federal loans are going to drop tremendously on any new loans you take out. So let's jump right into it, right? First and foremost, up until the early Barack Obama years in presidency, the way they used to figure out student loans is Congress just randomly get together and throw some shit against the wall and be like, that sounds like a good rate. And that's literally how they came up with them, right? There's no rhyme or reason on how they did it. It was mind-numbing, a stupid process, okay? And so in the beginning years of the Obama administration, he changed that policy. And now it is set on what's called the 10-year Treasury, and then they add an additional yield, additional interest rates to that, okay, to compensate for risk. What does this mean? So every May, Congress resets the rates based on a Treasury. I believe the date this year that they set it on is going to be May 10th. I'm not 100% sure of that, but I think it is, okay? So that means from July 1st of 2020 through June 30th of 2021, that's what the interest rates are going to be. So when you know that, you can be strategic about it. What does this mean? Okay, and this is specifically I'm going to be talking about for graduate school on this. Stafford loans, they're priced at 3.6% above the 10-year Treasury. Grad Plus loans are at 4.6. If it was priced today with current market prices as of right now, that means that Stafford loans would be at 4.21%. Grad Plus loans at 5.21%. So I'm going to go through 3 strategies you could potentially use to take advantage of these lower rates. Okay. First, if you've already been in school and you took out loans previously, if you have the ability to, after July 1st, when these come out, max out your loans. Okay. Now, you may have to max it out just to be able to live and survive and all that type of stuff. That's fine. But a lot of you don't need to max it out. Do so anyways. Why? You can take the extra money that's at the lower interest rates. Make sure, one, you have an emergency fund so when you graduate, you got cash sitting there. But if you have extra, you can then turn around and use that to pay off your higher interest rate loans that you took out last semester or last year or 2 years ago, whenever it was. In essence, you're refinancing your federal loan with a new federal loan at a lower interest rate. Take advantage of that, okay? The other way is that if you're starting school, or maybe you just started, like you're a semester in, maybe 2 semesters in, overborrow, even if you don't need it. Interest rates are at all-time lows. Probability of them going lower, pretty much 0. Even if they go lower, it's not going to be that much. Probability says, if anything, they're going to go up over the next year. Therefore, overborrow right now, even if you don't need the money, because it's cheaper. And then just save it for next semester and next year, and if rates go up, so be it. Take out less loans next year because you already have money in the bank this year. Now, one caveat to that. Money's in the bank, don't go spend it, right? Remember, this is a loan, so you're not trying to just blow it, okay? So therefore, that's just, should be a word of warning. If you don't feel like you have the discipline not to spend that money, don't do these strategies, okay? That's the second strategy. The third one is like if you're a student and you have other types of debt that are higher interest rates, so maybe like a credit card or something like that, then overborrow at the lower interest rate and use that money to pay off your credit cards. So that way you don't have any credit card debt anymore. Maybe you have a personal loan or something like that. Whatever it is, use it to pay it off. Some people say, well, what about car loans? I would potentially even think about paying that off too, because it should be right around the same interest rate. And car loans are pretty inflexible. Okay, meaning you don't have options, you're making the payments, all that type of stuff. Student loans, you have options. You can go like payoff strategies, you can go loan forgiveness strategies. Like right now, when shit's hitting the fan and the world's blowing up, government, put a 0% interest rate on it and no required payments. So there's flexibilities in there that you don't get with other types of loans, even if they're at the same rates. Okay, so think about that. Think about that. I even had one person the other day, it was like, they had some of their mortgage. Like, I'm gonna pay off some of my mortgage with this because, like, if I don't pay my student loan, who cares? Like, if I don't pay my mortgage, they're gonna come take it from me. I'd rather not have a mortgage, and especially if my interest rates on my student loans are at 4.2%. Why not? So that's how you can start mixing matches. That's more like a way more advanced strategy, so you don't have to worry about that. But just to summarize, again, this is a quick, short podcast for you students, so that way you guys know what you can do to take advantage of this. Number one, if you're already a student, you've been there for a few semesters, the interest rates on the new loans are going to be lower. So if you can overborrow more than you need, max out your loans, take that money, make sure you have an emergency fund post-graduation, and then turn around and use that money, that extra money, to pay off your higher interest rate loans. If you're just starting, overborrow. Okay, because chances are in the future, next year, interest rates are going to increase. So keep the money, it's cheaper, use it next year to pay it off. Okay? The last one is if you have other debt, especially credit card debt. Take out more, use it, pay off the credit card debt. Or if you have like a car loan, student loans are more flexible, use it to pay that crap off too. You'll be good to go. Again, if you guys have other questions, let us know. Keep an eye out for those interest rates. Like I said, July 1st is when the new interest rates are going to be taking effect and any loans dispersed at the July 1st. You guys got questions, let us know. Talk to you soon in the next podcast.